Welcome back. Let's talk about the markets. Where are we headed from here? Inviting Satish Ramanathan, CIO of Equities at JM Financial Asset Management on the show now. He runs two mutual funds for JM Financial. One of them is FlexiCap and the other one is Value. Satish, that's the big question, right? Indian valuations were never cheap to begin with. And even now, after the run-up, we're close to fair value, perhaps even slightly more than that. Where is it that you see value in the markets now?
Good morning, and thanks for having me on the show. We see pockets of value emerging in the mid-cap, small-cap, and some large-cap companies as well. So we've gone through an extended period of time correction, almost 18 months. And during this period, earnings have grown, and consequently, the valuations have become cheaper. So that's where we think that we should be fishing for opportunities.
Could you elaborate a little bit more? Where exactly, which are the themes where you are seeing value, and what is driving that value? Is it because the earnings have not been very strong, which is why the market has been skeptical and the valuations have come off? Explain a bit about the pockets of value where you see it.
Okay, so let me broadly focus it across three themes. Yeah. One is the interest rate hike that we have been seeing through globally for the past 18 months. And that seems to have kind of come off with the banking issues in the US. So I think the market is now factoring in a muted interest rate hike from here on. The second aspect is on liquidity. Liquidity was also tightening, and that was impacting markets. And that also seems to be reducing. The tightness is reducing with Bank of Japan and PBOC increasing the liquidity. The third aspect is, of course, in India. India was impacted by the Ukraine war, with raw material input prices going up significantly over the past 3 to 6 months from the war. That is up to September. We faced increasing input costs. And that's kind of rolling back, and we are seeing margins come back in the manufacturing sector. And therefore, we think that, we should normalize in terms of margins, and the course correction has already factored in. And that's what we need to look at from here on.
Satish, hi. Good morning, Surabhi here. So let's just expand on that point a little bit. You mentioned manufacturing, and Rima was telling us earlier, I think you have quite a few stocks from the capital goods and manufacturing space on your list: Kalpataru, KEC, L&T, BEL, HAL. We'll just put some of these names up on the screen as well. So just tell us how exactly you are playing the entire capex cycle. There's a fair amount of government capex. We know that. I mean, look at what's happening on the rail stocks, for instance. But how are you slicing and dicing this? And what pockets are you most convinced about, and why this selection of stocks?
Right. So what we see right now is that there is actually a pent-up demand for capital expenditure across corporate India. Corporate India was actually lagging and wanting to get some confirmation before they start investing. But we see that corporate India is now turning positive. They're moving to brownfield expansion. They're moving to greenfield expansion. And we are seeing FDI also coming into the manufacturing space. So when we put all this together, we think that there should be a construction boom in the country. And who better place than the big 3 or 5 names that we hold. So I think Larsen & Toubro is well proven, as also some of the other names that we hold.
Okay, Satish, thanks a lot for joining us. Another space I want to ask you about is all of these railway-related stocks. We've seen a big up move in some of them. We've been talking about a 50 to 60% kind of move in 1 month. Is this a space that you would venture into, and what is the kind of upside that you see here?
Yes, I mean, railways is sustained capex, because I think what is happening across states and cities is metro is taking off. It has taken off far more than we anticipated. So we are a little behind in that, but we think that that's a sustainable growth opportunity. And there are 2 ways to look at it. One is through the construction theme. The second is through the supplier theme. The construction theme, we have captured some of it. And the supplier theme also, we have a few names that benefit from a sustained growth in railways. Companies such as BHEL, ABB, and Siemens are likely to benefit from this sustained rally. So therefore, we think that we have broadly captured that opportunity.
What about IT? There are clearly a lot of external headwinds still. There is no visibility that growth is going to pick up firmly for the Indian IT services company. There is fear about a recession in the US. The extent of the recession can still be debated, if it's going to be a shallow, soft one, or is it going to be a hard landing in the United States. But there is less visibility when it comes to technology companies. But yet, there is value. So would you bet on the value that IT companies are offering after the recent correction? Or is it an avoid?
To some extent, IT companies do offer value, especially the mid-cap IT names that have come up after the recent correction. And what we see is that BFSI has been exposed to this correction, especially the companies exposed to the US. But Europe is recovering pretty smartly, and one should therefore select companies that have a more balanced portfolio and are less exposed to the BFSI space. As you are aware, because of the interest rate hike and the current small banking crisis in the US, there is a fear that some of these contracts may get cancelled or the volumes may come down. And therefore, what we are trying to do within the IT space is that we are looking at companies that have a more diversified portfolio and are less exposed to the US itself.
Okay, all right, got that. Satish, good having you on our show today. Thank you very much for making time and sharing some thoughts. We will take a